Okay, so now we're going to look at weak form tests. The Remember, if markets are weak form efficient, that technical analysis will not work. And for the most part, um, um, finance professionals believe that the markets are at least weak form efficient. The but if they are not weak form efficient, then we should be able to look at patterns in stock returns and profit from those. Some examples of those include returns over short horizons. Um, Now, what's called the momentum effect is the tendency of poorly or well-performing stocks to continue to do so to do the same over short periods. Momentum typically lasts for 6 to 12 months. The problem with the momentum, for the most part, people who've tried to use it find that uh, if you trade solely on the basis of the momentum, the profits are go away. The trading costs eat up your profits. There are firms that successfully use momentum as a to as a determinant of when to trade a stock that they're already going to trade. So uh, um, next would be returns over long horizons. That's the reversal effect. This is a tendency of poorly or well-performing stocks to turn and go the other direction. Um, Predictors of broad market performance. This is three examples of research into broad market performance. Fama and French are two pretty famous professors. They developed the Fama French model, uh, but they found the return on the aggregate stock markets tends to be higher when dividend yield is low. This actually makes some sense. If dividend yield is low, that implies that firms are reinvesting their profits. If dividend yield is high, firms are not reinvesting their profits, which implies that they don't have projects out there, profitable projects out there available to invest in, which would be the case when the markets are doing well. They have more likely to uh, have profitable projects available. Campbell and Schiller found that earnings yield can predict market returns in 1988. In 1986, Keim and Stambaugh found that bond market data, specifically credit spreads, the spread between yields, can predict market returns. Okay, semi-strong form tests look at market anomalies. Um, Anomalies are patterns of returns that contradict the efficient market hypothesis. One would be the PE effect, the idea being that low PE stocks exhibit higher adjusted returns than high PE stocks. The Another being small firm effect. The stocks of small firms can earn abnormal returns. This primarily occurs in January. Neglected firm effect, similar to the small firm effect, the idea that little known firms can generate abnormal returns. We'll see some slides here coming up that support these ideas. Book to market effect, the idea being that shares of high book to market firms can generate abnormal returns. The idea high book to market firms implies a undervalued firm or underperforming firms. The high book to market firms are commonly thought of as takeover targets. So there's some support for this idea. And other market anomalies, post earnings announcement price drift, sluggish response to prices, stock price sluggish response of a stock price to a firm's earnings announcement, or abnormal returns on announcement day. Momentum continues for some period of time after that. Bubbles. So, we've all seen speculative bubbles, where prices go above their intrinsic value or below. But even when prices are inaccurate, it can be difficult to take advantage of them because we don't ever know when the markets are likely to correct. Figure 8.3 shows the annual return of 10 size-based portfolios. We can look at they have 10 groups here, 1 through 10. We can see that the returns of the small firms, or decile 1 as they call them, are much larger than decile 10, and there seems to be some consistent decline in the returns across the size, implying that the small firm effect is truly a valid point. The book to market ratio, figure 8.4 shows the annual return in relation to book to market ratio. We start out with low book to market firms, and we have an annual return of 10.9%. We go to the highest book to market firms, and deciles 9 and 10, and we see that their annual returns are significantly higher. Figure 8.5 shows cumulative abnormal returns after earnings announcements. What we have is earnings surprises. We have 1 through 10 again, and they're divided up into the deciles. We can see when a stock has has a positive earnings announcement surprise, that price drift continues long after the announcement. The significant price increase is right at the time of the announcement, or even just before. That certainly implies that there's a potential for insider trading. We can see the same when we're talking about the declines. This would be a negative announcement. That decline continues for some period of time. We're showing up to 90 days